Yes, good afternoon members and guests, and welcome to LGIAsuper's first Your Super in Retirement webinar. My name's Kate Farrar, I'm the CEO of LGIAsuper, and I'm joined by our wonderful Advice Manager, John Mulcahy, and our fabulous Chief Investment Officer, Troy Rieck. Today's webinar will help you to discover ways to get the most out of your superannuation during retirement. For the first 15 minutes or so, John is going to take you through some of the things to bear in mind when you're investing during a market downturn. Once you've retired and you're no longer earning an income, it can feel like there's a lot more pressure on your investment choices. But how you respond to a market downturn can have a really significant impact on the quality of your retirement and your superannuation balances ongoing. Troy will then be providing you with a market update, always one of the most interesting parts of the webinar, and he'll be demonstrating the strategy and consideration that goes into how he and the team manage your money during all of these times. You're then going to hear from John again, and he's going to cover a few of the options that you have with your super during retirement, as well as any potential government benefits that you could be eligible for. Finally, I'm just going to take 5 minutes of your time to give you an update on our proposed merger with Energy Super. At the conclusion of those presentations, we're going to have an interactive Q&A session. We really do want to make these webinars very relevant to you, so we really encourage you to think of all the questions that you'd like to ask. And at any point during the webinar, you can in fact lodge a question with us by clicking on the little blue hand on your screen. We'll address as many questions as we can during today, but rest assured that if we don't get to your question, then we'll get back to you over the next couple of days and give you an answer. So that's it for me for the moment. I'm now going to hand over to John.
Thanks, Kate. And thank you to you all for joining us and welcome. I imagine when you decided to retire, 2020 was probably not exactly what you had in mind. I think it was probably looking forward to some freedom and fun, and rather than isolation and fear. In talking to you today, what we're hoping to do is share, as Kate said, share some information with you to hopefully let you feel comfortable about your financial security both now and for your future retirement. And just thought we'd start with a few images that some of you, our members, have shared with us of them enjoying their retirement. Some of the contributors might be joining us out there, so hopefully you are, and hello, and thank you for sharing your photos with us. Now, these were clearly taken back in the good old days, 2019 or 2018, and hopefully we'll get back to being able to enjoy these type of activities again soon. But certainly when our advisors are meeting with you and talking to you about retirement, it's very much the type of activities that you tell us that you want to be able to enjoy in retirement. And I guess now it's interesting whether, as we move out of this phase of COVID at least, whether everyone's looking forward to getting back to these activities, and I'm sure many of you are, or whether to some extent COVID might change our outlook for retirement and what we want to be doing. Will it be more likely to be local travel instead of cruises, or caravanning instead of travelling overseas? I'm sure we'll get back to those activities that we've really enjoyed in the past. It's just a matter of when I guess we can do it with great confidence again. Now, just before we move on, just I guess important warning, we've got lots of different people watching us at different stages and different lifestyles. So today's really just about information for you to take on board, and we certainly encourage you to apply that to your own circumstances, and if you're looking at products, to look at the disclosure statements for those products to make sure that that is the right thing for you to do. And certainly we don't want to just give you that information and leave you to your own devices, so we'll also confirm how we can assist you as needed with questions and clarifying what all this might mean for you yourselves. Now, about 12 months ago, we were doing a presentation on much the same as this, and I was talking about at that stage how good things had been for quite a long time, and referred back to events like the GFC and so forth. And I actually made the comment then that, look, we know it'll happen again, we just don't know when it'll be, what the trigger's going to be, and how bad it's going to be. Well, we now know it's going to be early 2020. We know the trigger is going to be a global pandemic. That's pretty impressive as well. And that is going to be very significant. Although, interestingly, and Troy will talk about this in a moment, from an investment perspective, at least so far, relatively, I guess, almost recovered as well. So it's quite an interesting year. Certainly an interesting year we've had, and where to from here. But having said all that, and the reason I brought it up last year and the reason we talk about it again today is because when these things happen, they're definitely not fun, but it's important to know that they are part of investing, they're part of life, and so it's about being prepared for that, so that hopefully when it does happen, you feel confident enough that you don't need to make any wholesale changes or overreact. And if I ask you how you felt at the beginning of the year when you saw health concerns going up around the world and at the same time the value of your investments going down, I'm sure you wouldn't have been too excited about things. And it's definitely easy to be overwhelmed, especially you've got the media making headlines and talking about how bad things are and asking questions about how bad things can get. And if we look on this slide here, we see that in just the 2 months of February and March, the return from the diversified growth option in our pension had fallen by about 10.4%. Now, if anyone tried to tell you that that's not significant, I'd definitely suggest that you don't listen to them. But I think really, when this is going on, the question really should be is, should I do something? Because that's clearly a very human trait as well. When things are going bad, we feel a bit helpless, so it's natural to probably want to try and take control. And we'll look at that now, because one of the things I guess you can control is how you're investing your money. And in super terms, that security, I guess, is often takes the form of cash or low-risk investments. And as we can see here, cash over the same 2 months produced a very uninspiring positive return of 0.17%. But that's amazing compared to the loss of about 10.5%. So what I would suggest you ask yourself, though, at times like this is, well, what else has changed? If you're still looking at the same period of time in retirement and you still want to maintain the same lifestyle in retirement, have the same retirement goals, and if in January of 2020 your investment strategy had taken those things into consideration, then I'd argue that there probably should be no need for wholesale changes. Now, I know that's very easy for me to sit here and say that. It's your money and your future that you're sort of watching going down the drain. But I still make the point, when you retire, do you retire for 2 to 6 months, or are you retiring for 10, 20 and 30 years? And it's really important because these reaction in the short term can have significant implications. Yes, that's right. And we'll look at that now. So this slide here now is looking at this calendar year to date, so going back to the 1st of January through to the end of September. And after that significant drop early in the year, as I was talking about, you can see now that the gap has really narrowed, and cash, yes, it's still been a better performer, but only by about 2%. And once again, as Troy will talk about in a moment, since preparing these slides, markets have continued to rally, and diversified growth actually now back in front of cash over that time frame. So reacting can be dangerous, and also if you got out of diversified growth at some point in that downturn, even if you've now got back in, you would have locked in a loss, and therefore you'd likely still be behind over that time frame. Now, what if we keep moving out and look at the full 12-month period? So September 2019 through to the end of September this year. And this is pretty interesting, I thought, because interestingly enough, they both ended up at pretty much the same point. So again, it's been very natural for you potentially to look at that and go, well, if I'm going to get the same return and one's a nice steady return and the other one has a lot of anxiety attached to it, then I'll take the low risk or the seemingly low risk option. But once again, I remind you that if you were stressed and when it dropped and you got out along the way, you actually wouldn't have made that all back up just yet either. And over time, we continue to look at these two. The risk really does become greater. And why? Well, look, cash does exactly what we expect cash to do. No real volatility, doesn't shake around. It gives us certainty, but it also gives us low returns. And that's why, look, cash is so important, because it does give us that peace of mind in the short term for money that we're going to need maybe over the next weeks or months or even a year or two, rather than long term. And we can see here over 2 years then the return from diversified growth has actually been 8.5% compared to 2.8% for cash. And that does include that significant drop in the market that we saw earlier this year that we just looked at. But let's keep going. Look at this over 3 years, the trend continues. And I think it's interesting with diversified growth. The reason I won't stop there, we'll keep building on this, is because diversified growth as an investment option isn't designed for 1 year, 2 years, even 3 years. It's really structured in a way to produce rolling strong returns over 7 years. Why? Well, because that's really aligned with the typical investment time frame that you as members, even as retired members, most of our retired members still have a long time that they expect to enjoy retirement and need their super to perform for them. So it's really about aligning that. So here we see over 3 years, diversified growth, 21% against 5% for cash. If you want annual numbers for that, that's about 6.6% per annum for the last 3 years for diversified growth versus less than 2% for cash over the same time frame, or 1.6%. Look, and so it goes. The gap keeps increasing. 5 years now, 45% or 7.7% per annum compared to a total of 9.5% or a bit under 2% per annum. And remembering, once again, including that COVID correction earlier this year and also including what at the time was a reasonably significant correction in late 2018, which interestingly is sort of almost a non-event now. And I guess that is what happens with these events, as we talked about in the past with the GFC and 1987 crash and so forth. Over time, they lose significance. And 7 years. So at the end of seven years, diversified growth to the end of September this year, 68% return, or still an average of 7.7% per annum every year over those 7 years, compared with only 15% from cash. Now, I know that many of you might be thinking, yeah, John, but look, I'm going to get out of cash because it's going to give me some peace of mind in the short term. Obviously, I'm not going to stay investing in cash for 7 years. Well, sadly, I've seen it, and it does happen because once you get out, when are you going to feel confident to get back in? And so, look, what's the lesson? Well, like I said, cash is great, but only great when it's used for what it's good for, and that's that short-term security. Whereas more growth-based options allow us that ability to generate a real return or decent returns on our money over time to help improve the ability for you to sustain your retirement for the time frame that's likely to be needed. Yep, they can be a bit nervy in the short term, but if you can resist the evil grip of fear and greed in the short term and have confidence that you've got the right strategy for what you're trying to achieve and hold tight, as we say, history has proven that the returns will be achieved. With that, look, I just want to say a welcome for anyone who might have joined with us since the start. We are very interested in your questions today, so please do send them through to us as we go. There will be a question and answer at the end. And to ask a question, there's a little blue hand icon there. Please click on that and send your questions through. And having covered those points that I have, I think it's probably a good time now to pass over to Troy so that he can talk about how he and his team have been managing the money for you and what the outlook might be. Thanks, Troy.
Thanks very much, John, and good afternoon, everyone. As John mentioned, there's a little blue hand on the top of the screen. If you have any questions, please send them through. I've prepared some material for us to talk to today, but what I'd really like to do is to answer any questions you might have. Let's look at the year in review. I won't spend too much time on this one. We'll start with the obligatory COVID-19 chart. And it's very easy to take for granted the amazing job that we've done here in Australia in dealing with the impacts of COVID-19. You can look at Victoria, which has now officially eliminated COVID-19 as an infection after 30 consecutive days of 0 infections and 0 deaths. You can compare that experience to what we see in many other parts of the world, including the United States, with the world's most advanced health system, where we're now seeing about 180,000 infections a day and 10,000 deaths per week. It's had a tremendous impact on the entire planet. But there's some great news coming. We now have 3 vaccines in phase 3 trials, including one that doesn't require deep freezing to stay activated. We're obviously very confident that the future will be different to the past, and we're very hopeful that these vaccines will be quickly developed and distributed. That impact on society translates very quickly into an impact on the economy. We've seen, particularly in Victoria, but all around Australia, governments taking action to deal with the impacts of COVID-19 by effectively putting the economy into hibernation. We've seen our first recession in 30 years here in Australia, and it was a severe one, more severe than the global financial crisis experienced around the world. We've also seen the inflation rate turn out negative. That again is the first time in 3 decades. Perhaps the easiest way to see the impact of this economic disaster is in the effective unemployment rate. Earlier this calendar year, as COVID-19 impacts were peaking, the effective unemployment rate, that is, people who are out of work and those who are in work but not currently working any hours and therefore supported by JobKeeper, reached almost 15% of the workforce. That's even bigger than it was in the late 1980s, early 1990s in our previous recession. The good news is now, as we've done such a great job dealing with the virus and the economy continues to open up, and the borders in particular are now opening up, people are getting back to work. That gap between the effective unemployment rate and the actual unemployment rate is largely closed, and unemployment is also falling at a rapid rate. That's really good news for everyone concerned. The societal impacts, the health impacts, and the economic impacts have also flowed through to impacts in investment markets. What we're looking at here is the S&P 500 index. It's the world's largest share market, and the impact here from late February to late March in particular, as COVID-19 effects were most visible. This fall of 35% from peak to trough was the fastest fall in the S&P 500 index in history, apart from the share market crash of 1987. But there's something else very interesting about that chart. It's the rapid bounce back that we've seen. We've seen this effect in most share markets around the world, including our share market here in Australia. This rapid bounce back in share market prices tells us that investors are starting to look through the current impacts and expecting much better, more normal economic times ahead. And one of the reasons that those expectations are coming about is this rapid bounce back in the Chinese economy. The chart here on the left-hand side, as you can see, China was the first major economy to go into recession as a result of COVID-19, but also the first major economy to bounce back. Right, that pink line there is particularly important for us here in Australia because China is our largest export partner. On the right-hand side here, you can see the impact of this economic rebound in the price of iron ore. Iron ore exports are a major economic earner for Australia, metallurgical coal, tourism, education. China is our largest export partner. We are having some hiccups at the present time, a little bit of a trade dispute, but those dollars coming in the door from sending minerals and other exports to China are so incredibly important for the Australian economy. It's one of the reasons why we're now doing so well compared to the rest of the world. So given all of this turmoil and uncertainty around the place, how did things actually turn out? What are returns for members looking like at the present time? Well, despite all this uncertainty, financial market returns are actually really positive. If you were just to view the returns for the calendar year to date, as John indicated, you wouldn't even know where COVID-19 occurred. That can be a really strange and puzzling event for members. But it's a really pleasing outcome for us because it means more money in members' accounts. What we're looking at here is the returns after fees and taxes have been deducted to the diversified options in the pension phase. A lot of members are invested in diversified growth, which is returning here almost 9% to 16 November for the financial year, as well as balanced, which is returning 4.9%. November has proved to be the best market returns in 35 years for the share market here in Australia, and a similar outcome in the US. So even since I produced this chart in mid-November, returns are even better. If you've been lucky enough to be invested in our Australian equities option, you've returned 16% for the financial year to date to the end of November. That's an outstanding outcome. And again, completely at odds with people's expectations for what's happened given the COVID-19 impacts that we've seen. It's so very important for members to realise that we're in a long-term investment game here. These short-term impacts can be incredibly distracting and very psychologically painful, but financial markets do often deal with them very well. So the returns that members are seeing are excellent, but how do they compare to the returns that other funds are generating? What we're looking at here is a comparison of LGIAsuper member returns in the green bars against the average super fund out there in the blue bars. And these are results to 30 September 2020. What you can see is that the returns for LGIAsuper here are ahead of the median fund. And what that means for our members is you're building your retirement balances faster than the average person in the country. And that makes us very proud. You can see that gap in returns there for the 3 and 5 years numbers in particular. That means more money in your account compared to the average person in Australia, perhaps 5% more over 5 years. That's the sort of stuff that really gets us motivated here in the investment program. The same's true in our other popular option in retirement, and that's the balanced option. Balanced option here is performing better than the median fund. It's a top quartile performer over 1, 3 and 5 years. It's our standout relative to peers. There's another important message though in this chart, and John's been talking about this one already. It's the importance of being a long-term investor. You can see those rolling 10-year returns there of more than 7% per annum. All else being equal, that means your account balance would double every 10 years. Even for members who are in retirement, you have a long-term retirement perspective, you have a long-term investment perspective, you have to deal with the consequences of inflation. Inflation might always be negative. Being able to deal with that by staying invested for the long term, being able to let wealth compound, is a really important weapon for our members. So current returns are excellent. We're living in interesting times. The important question is, what do returns look like going forward? Well, it is a compare and contrast exercise. COVID-19 has been such a big issue. It can be incredibly distracting for us. You wouldn't see it in the investment returns if you only looked at the start and the end point. Our focus here is upon the next 18 months, 3 years and beyond, but thinking more importantly about 5 to 10 years out. Let's start by looking at share markets. Share markets are very much pricing in an economic recovery here. How do I know that? Well, first of all, share prices are going up. Number two, the rate at which share prices are appreciating is greater than the rate at which profit expectations are also rising. Now let me talk about that for a moment. In the top chart here, we're looking at the Shiller PE ratio, and there's an easy way to capture this one. This is simply the price that investors are willing to pay for $1 of future earnings. The higher that ratio is, the lower that future expected returns are. Now you can see that in recent years that price has been going up, and that's been very beneficial for members who've been invested in the share market. Total returns for share market investments have been excellent. The bottom chart here looks at the other side, which is what are people expecting future profits to look like? You can see it as we headed into COVID-19 in the middle of this year, profit expectations fell very rapidly. Now, we're starting to see those profit expectations really bounce back, particularly for financial year 22 and 23. The key question is here, given those rising prices that people are willing to pay for earnings and the rising earning expectations themselves, can we generate enough economic growth to justify those share prices over time? That is literally the $64,000 question. And the interesting part for us here is that not all parts of the share market are pricing this recovery equally. There's an enormous gap, in fact, between what people call growth stocks. These are your technology stocks, the Apples, Googles and Amazons of the world, compared to so-called value stocks. These are energy companies, miners and banking stocks. There's been an enormous price differential between these over the last 5 years, and we've captured that in the left-hand chart. It's the price of the average growth stock versus a value stock. Now this has been very beneficial for LGIAsuper members. We've been overweight in growth and underweight in value. But this performance differential has been so great, we've been trimming those overweight positions and buying more of those value stocks. We've also used this opportunity to start selling down some of our international investments and buy more domestic investments. And that's just a way to increase our our value exposure here in the portfolio. The reason we're doing that is we're expecting better economic times ahead, and mining, energy and banking stocks are a good way to capture some of that economic expectation. It's also a way for us to help manage some of the risks that we see in the current international equities market. You can see here on the right-hand chart that the number of stocks that make up the market value of the top 5 stocks in that international equities index has continued to rise over time. In fact, that peaked out at around 25% recently. That's actually quite concentrated for a global equities portfolio. So all we're trying to do here is deal with some of those concentration risks by selling down some of the international portfolio and bring more of our money to put it to work here at home. There are one set of financial markets out there that aren't pricing an economic recovery, and that's the bond market. If we look at the bottom chart here, we're looking at the yield to maturity, call it the expected return, on a 10-year US government bond. Bonds are very challenging assets for long-term investors. The expected return of 0.6% per annum for the next decade is going to be less than what we think the rate of inflation will be over that time period. That makes them very hard assets to hold. It's particularly challenging when the liquidity within bond markets as well has been falling, And so we prefer to use cash as a more defensive asset in our portfolios here. But there's strong contrast between the pricing we see in share markets versus bond markets in terms of that economic recovery is one of those interesting questions we're trying to deal with. So for folks here in the pension phase of the plan who are drawing down their money, one of the big focus points for us in the investment program is to build in a more sustainable income generation to those investment portfolios. And one of the ways we're doing that is by selling down these low-yielding bond portfolios and investing into other assets. We're looking to generate more returns over time from income versus capital gains, and we're looking to reduce our exposure to some of these very low-returning assets. So we think the world ahead is a more challenging environment to generate long-term returns. We think those expectations for profits are rising very fast, and so are share prices. And obviously, on behalf of our members, we hope that continues. The challenge we see in those expected returns and helping members to build their account balances over time, that's a challenge that the investment team and I welcome. Thank you very much for your time this afternoon, and I look forward to taking your questions.
Excellent. Thanks very much, Troy. I think it's fantastic to have someone as knowledgeable as Troy is and as passionate as he is, and also someone who genuinely wants to make a difference to the returns of the members. And I'm sure you'd agree they're three pretty important characteristics for the person who's managing the billions of dollars of your retirement money to have. And just in rounding out this investment section and building on what Troy said there, I guess I'd just like to talk a little bit about the key aspects of your options, because I was talking about diversified growth and cash earlier. I'm certainly not, the intention of that wasn't to say everyone should be in diversified growth. It's certainly not the case, but rather just to understand that there is a range of options available to you, and it's the challenge, I guess, for you is to marry up what your income and growth needs are on your money and sustainability for your retirement and matching that up. And just one of the important aspects on this slide, I think, is just, again, I guess I've been touching on it indirectly, but getting a negative return on your money is to be expected. Unless you're going to, as Troy was just talking about, the woeful returns from bonds, and as I've already said about the returns from cash, unless you're prepared to accept almost no return on your money, you need to accept some risk. And that just means that markets are going to go up and down over time, and there will be times where we'll experience a negative return. So if we stay on diversified growth, that means that on average we expect that you get a negative return about 1 in every 5 or 6 years. If you go more aggressive, then that frequency will be a little bit more common, but the trade-off with that is expected greater returns over time. And conversely then, as you move through the more conservative options like balanced, stable and defensive, well, yes, you won't expect negative returns as often, but the downside of that is that those returns that come with those options will not be as significant. And really, I guess the key point with all of this is thinking in advance, making a plan in advance so that when these events do happen, you're not going to have to react in the short term, because you can have confidence that your strategy is solid. Just sort of taking another moment just to ask or remind you about the questions. So if you do have any questions there, please do send them through the little blue hand icon there. And if you have joined us since the start, thank you very much. Now, just before we move on to talking about sort of government benefits and the like, I just sort of take a moment just to stay on super and talk about what your options are for accessing your super in retirement. Because generally speaking, for most people, there's really two main options, and that's continuing with your standard super account, or what we call an accumulation account, and just making lump sum withdrawals from it from time to time, or moving your money into a pension account or an income account and getting your income that way. So we'll look at some pros and cons with that. So if we start with the accumulation account, there can be reasons to do it. And again, as an advisor, I guess we would see probably the main reason or the main advantage that keeping money in an accumulation account when you're retired could be, is that if you're not yet pension age, and we'll talk about that in just a moment, then those funds are exempt from the government tests, which we'll talk about soon as well. So there may be advantages as far as that goes. But there are certainly disadvantages, and those disadvantages can be quite costly, especially over time. And one of those or in my view, the most significant aspect of that is that by leaving money in an accumulation account, the investment earnings that we've been talking about, well, they actually still get taxed at the fund rate of 15%. So all those returns Troy was just sharing with you about returns on the pension funds, well, they were all net of, or didn't have to pay tax. So those returns, if you look like for like with the comparative option in the accumulation phase, will not be as great. So, and over 1 or 2 years, that might not be terribly significant, but over 5, 10, 20 or more years in retirement, it can certainly add up. So definitely a very important one to keep in mind. So what's the alternative? Well, the alternative is to move that money into a pension account. And I've got no doubt that many and possibly most of you watching right now are utilising a pension account. So what are the advantages? Well, again, as advisors, we really see there's probably what we see as two main advantages of moving into a pension account when you retire. Firstly, it's that flip side of what I was just talking about. Once you move into a pension account, all those funds are now invested tax-free, ensuring that you keep as much of that return as possible for you, improving your future outlook. And the second one is the fact that you get paid income. So we find in talking to most people, their preference in moving into retirement is to be able to continue to get a regular payment, much the same way as you received your wage while you were working, because that's what we become used to in terms of budgeting and meeting our lifestyle expenses. So it makes it easy. I mean, there's a lot going on when you retire and it can be very daunting, and that's one other way that can make it easy by just continuing to have that income replacement so you know your living expenses continue to be met. Now, are there negatives to a pension account? Well, yes, and let's look at those now. Although I must admit, in putting those first two in, it's sort of almost a bit tongue-in-cheek really, because I would ask you at the same time, are these really negatives? So the first one there is, yes, well, what if I don't want to receive income? Because certainly once you move money into a pension account, you have no choice. There is a minimum requirement that you have to receive as a pension payment each year. And some people say, well, I don't need the income, so I don't want to draw on it. But I guess my question to you is, well, even though you have to draw a minimum, is that worth leaving all the money in an accumulation account if that means that you're going to have to pay tax on all the investment earnings on that money? Or might there be another way to go about that problem, if you like? Second point there is you can only put $1.6 million into it. Now, again, is that a problem? Be a nice problem to have. It might be a problem if you've got a lot, and at the risk of offending people, maybe if there are some greed issues, that might be an issue. But really, those 2 points, generally speaking, might be an issue, but are they really? The last one there, and I've included that as a negative, although really I want to make a very clear point about this one, and that's its relationship to the asset test and the income test. And I mentioned that a moment ago with accumulation. So what I mean here is, certainly if you're looking at starting a pension account, it's important that you just make sure that there's not going to be any negative unintended consequences of starting it. And where that's most likely to be the case is if you are not yet pension age, and it could have a bearing on government benefits that we'll talk about in a moment. But for people, once you've reached your pension age, regardless of whether your money's in the accumulation account or in that pension account, they are going to be treated exactly the same way for government means test purposes. So we're really sort of talking more a short-term issue there. So having said that, I guess, and importantly, regardless of which account you have it in, once you're 60, in most cases, you're going to be accessing that money without tax. So that doesn't play a part in that decision as such. So if we move on from that to the government benefit side of things, there's really, and starting with the age pension, there's really 3 key points. And apologies to those of you who are already on the age pension or you feel you know it quite well. If you allow us to digress a little bit here, because there will certainly be some people joining us, I'm sure, who aren't fully across these things. And hopefully you yourselves will become a little bit more aware of some aspects. So first of all, there's no retirement age in Australia, but there is an age at which you become eligible for the age pension, and they're shown here. So that's currently age 66, and that is moving to 67 over 2 steps in the coming 4 years. Now, there are two tests that are then applied once you are age pension age to determine whether you'll be eligible for a payment or not. First of these is the asset test. And I'll talk about that first because we find that in most cases, this is likely to be the test that will determine, when you're fully retired, whether you have an entitlement or not. So the numbers we've got on the screen here relate to singles and couples and for homeowners. So if you happen to be a non-homeowner, these thresholds are slightly higher. And the relevance of these numbers is once your assessable assets exceed these levels, then no, unfortunately, you don't have an entitlement to any age pension. But if your assets are below this threshold, then you will have an entitlement to at least either a part or possibly full pension. The other important point to make there is, of course, your home is an exempt asset. So we're talking about other assets like your superannuation, other investments, cars and so forth. And I guess just to close out about assets is it is also very important to update your details with Centrelink and make sure they are fully aware of the value, and especially if there's a significant change. I guess that significant change, sometimes in retirement comes in the form of an inheritance or the like. But also, don't miss the opportunity that might be there too. So, I just spent a number of minutes talking to you about the correction that we saw earlier on in the year. Well, when those events occur and there is a reasonably significant drop in the value of your assets or your investments, then get online or to Centrelink and update your details, because if the value of your assets have fallen, then your entitlement to your fortnightly pension may have increased, and while that, relatively speaking, might not be as significant, it might help take a little bit of the pain away during that temporary period while your super assets are reduced. And importantly though, when you do that, we can't have it one way. So when things recover, naturally we do have to also then report the values back up. So that's the asset test. Like I said, that's probably the most dominant one that affects people. But there's also an income test. And no surprise, which test applies? Well, it's the one that gives you the worst outcome. So you could be full pension under the income test, no pension under the asset test. Well, sadly, then there's no pension. But if we look at the numbers here, so for single and couples, 53,000 odd for single and 82,000 for a couple. Now, I'd almost go as far as to say they appear generous. Now, I know that's probably a bit of a foolish thing to say, but why do I say that? Well, actually, I'll come back to that in a moment. When is the income test mostly relevant? It's probably if someone's still working. And I just want to call this out because unfortunately I've seen this a number of times over the years where people might be of age pension age or their spouse might be of age pension age, but they're still working. And so they think, well, I can't get the age pension because I'm still working. But it's really important to differentiator to make because there's no work test. It's an income test. So especially if you're only working part-time or casual, then there's every chance that you might fall under this threshold and actually have an entitlement, even if you are still working. So really important to look into that and make sure that you're not missing out if you're eligible. Now the next, I just want to take a moment stepping on. This is kind of still related to the income test, and I want to draw a link between deeming, which is a term many of you might have heard, and super income that comes from a super pension and what it actually means. Now, from 2015, there was a change. So for most people now with getting an income from a super pension, it's not actually how much you draw from your pension each year that's going to affect the income test, but rather deeming. So just to take that through for you, and you can see some numbers on the slide here. So what's deeming? Well, deeming is basically the government just pretending that everyone is achieving the same return. And I think this is something that really does make a lot of sense. If you think every single person had to report the actual returns they were getting on every investment they've got, it'd be a nightmare both for you and for the government. So a simplified approach, I think, which does make sense. So what it is at the moment, you can see those, again, different thresholds for single and couple and the current rates. So the current rates are 0.25%, and that applies up to those thresholds, and then 2.25%, which applies to any value of any financial assets above that. So financial assets, money in the bank, shares, managed funds, and your super. Regardless of, again, whether it's super in a pension or any super if you're age pension age. So let's just go through that example quickly just to show you what it means. So we've got a single person with $200,000 between money in the bank and their super. So they'll be apply a rate of 0.25% on the first 53,000, then 2.25% on the rest. So as you can see there, that's an annualised income assessment of $3,440. Now let's say this person has a super pension and they're receiving $30,000 a year from that super pension. Well, what applies for the income test? $3,440. So it's actually quite an effective thing, and a lot gets made about deeming rates, but certainly while rates are so low, it's really unlikely to have a significant effect. But obviously there can always be some exceptions to that. Now, yes, if you have, those of you who've got age or eligible or receiving the age pension now know that you get concessions that come with that. And I'm sure those of you who haven't got the age pension are well aware of some of the concessions that are available to age pensioners, and I've heard the desire to receive those over the years. And importantly, a few years ago, the government did make a move to move a number of those, besides the health benefits, some of the other concessions onto the health card. And that's really relevant because most people retired at the moment are eligible for a healthcare card. Now there's two main ones, and I'll just take you through those quickly now. So first one, and the health card is available to people of any age, and we refer to it as a low income healthcare card, and because there is an income assessment. So what I've shown you here is, because of those deeming rates, these are the level of assets that you can currently have and still, under deeming, fall under the threshold. So for a single person, you can still have about 1.3 million in financial assets and potentially qualify for a healthcare card. 2.3 million for a couple. So, that's quite significant. Once you hit pension age, that's when the seniors health card becomes available. And those thresholds move up a little bit there. So hopefully you can see there. So for a single now, that's $2.5 million. And for a couple, that's about $4 million. So that's why I say most people retired in Australia at the moment, even if not eligible, well, most people are still eligible for some age pension, but even if you're not, it's highly likely, especially in this current low interest rate and low deeming rate environment, that you probably have an eligibility for a healthcare card. So if you don't, I strongly encourage you to get in touch with Centrelink, so the Services Australia website. Centrelink have an excellent service called a financial information service. You can have phone appointments. I don't believe they're doing face-to-face at the moment, but go onto the website and make inquiries, because if you're eligible for it, why not receive it? Now, I'll just duck back to super quickly just before we head on to the question and answers, which I'm certainly looking forward to tackling with you. But like I said, just back to super, because there have been a couple of changes reasonably recently that you might not be aware of in terms of how you can add money to your super. So first of all, it's now 66 and under, or under age 67, that you can contribute to super at any time. So there's no worked test associated with that. So even people now who are 65 and 66, even if you're retired, still can contribute, whereas that previously was 65. But clearly they're moving that in line with the future age pension age. What about when you're 67? Well, for people 67 and older, nothing's changed there, unfortunately, so you do still have to meet a work test if you want to be able to make a contribution to your super. If you're not familiar with the work test, what that means is you need to be gainfully employed for a period of 40 hours within a consecutive 30-day period in that financial year in which you want to make a contribution. And thirdly, and this has been around for a number of years, or a couple of years now, but it's still fairly new, and just wanted to touch on again, and that's called a downsizer contribution. So what this one is where you're 65 or older, and you've got to that stage where you think it's time to, the house is too big, or you might be wanting to discourage family staying or coming back. So this is where you can sell the home, and if you've got surplus left over after you make your future living arrangements, up to $300,000 per individual, so potentially $600,000 for a couple, can be moved into your super. And that's regardless of the work test, and also regardless of how much money you already have in your super. But I guess importantly with that one, unsurprisingly, there's quite a bit of fine print with eligibility there. So if you are thinking of that might apply for you or it's something you might want to take advantage of, definitely I encourage you to look into it before you go and sign a contract for sale on your house. So the last little bit, just to close out, I guess, that, and just show you a little example of how a downsizer might work. So here we can see someone who decided to retire at 65, single, about $276,000 in super, and wanting $45,000 a year in income. So they are eligible for a full age pension, and so what this shows you is the outcome's not too bad, but around about 80, that super is exhausted, which means now fully reliant on the age pension from that point on. And that's a drop of income of around about $20,000, so certainly not insignificant. Now, at 75, this person was ready to downsize, and after they'd made their new living arrangements, had about $200,000 left over, and so used that provision to add that money to their super. So that's why you can see the second mountain there, if you like, that injection of funds, which now enables them to maintain that desired income level of $45,000 all the way through to around about age 90 in this example. So it can be a really effective way of keeping retirement simple and being able to maintain the liquidity and cash flow to maintain that lifestyle that you want. But certainly, as I said before, if you think you'll be at that point in the future, or if you're at that point already right now, definitely encourage you to get advice before you proceed. Now, I guess I'd like to leave you with some fond memories of the past and I guess hopes of good times again in the future once we move beyond 2020. Hopefully by joining us this afternoon, we've helped you feel a bit more confident about the nature of your investing and making those investment decisions. By listening to and hearing Troy, hopefully it's also helped that confidence that you have in the method that we adopt with your money to make sure that we're balancing the future returns with the here and now. And also being aware of what might be available to you in the form of benefits from the government so that you're definitely not missing out on something that you might be eligible for, sorry. And look, from all this information, we'll do the question and answer in just a moment, but if you do need assistance with this stuff, we've got a range of specialist staff who can help you. So there's email and phone number there for you. You will receive an email following today's webinar. We'd really encourage you to respond to that for us, and certainly that gives you the opportunity to raise anything that, if you'd like us to contact you to discuss anything specific for you and your circumstances. So with that, I'll throw back to Kate, and we look forward to doing some questions. Thanks, Kate.
Thanks very much, John and Troy. Members and guests, I hope that you found that as informative as I did, and hopefully you have now some tips for managing your super in retirement. I must say it always makes me feel really good when I listen to the professionalism and the passion that the team all bring to managing your money and making sure that we give you your best possible retirement. If you've just recently joined us, my name is Kate Farrar. I'm the CEO of LGIAsuper, and with me here is John Mulcahy, our Advice Manager, and our Chief Investment Officer, Troy Rieck. I understand that there have been some technical issues with the live streaming of this webinar, and obviously we apologise for the inconvenience there. We will be loading a recording of this webinar within the next week or so you can catch up on any parts that you might have missed. But of course now we do still want to continue with our intention to answer all of your questions and make this as relevant as we possibly can for your members. Before we do that, I'm just going to take a little bit of time, as I said at the start, to speak with you about our proposed merger with EnergySuper. We announced that in October, and I guess the main question that we have from all of our members is who is actually EnergySuper? It's been great to see the level of interest that members have had in our potential partner and in our proposed merger. So hopefully I'll answer some questions for you today now, but also please feel free to send any questions in by clicking on the little blue hand on your screen. So EnergySuper is an industry fund that looks after, or has traditionally looked after, members of the Queensland electricity industry for a long period of time. Contrary to what the name might suggest, our local government focus fund actually has a lot in common with Energy Super, and that's one of the reasons why the board decided that we would pursue this merger. I guess the first similarity is our history. Energy Super has a heritage of more than 40 years as a specialist sector fund working with Queensland Government electricity employees, just as we do our 50-year heritage working with local government employees. Also, like our fund, Energy Super has become an open fund in the last couple of years, which means that whilst their membership has a lot of concentration in the energy sector, it does in fact welcome people from all industries right across Australia, in fact. Like us, Energy Super is a profit for member fund. So that means that none of us are trying to return profits to investors or shareholders, and allows both of us to ensure that members are right at the centre of all of our decision making when we decide how we're going to approach the future. Energy Super is a Queensland fund that's headquartered in Brisbane, but actually services all of Queensland, which is fantastic. So they deliver strong workplace engagement, just as LGIAsuper does, and a program of education like this one that we're preparing for you now, and assistance for members with financial literacy. Energy Super shares the same aspirations that we do to achieve better scale whilst remaining personalised, so we can continue to give you the great personal experience that you have grown to love with us, but do it, efficiently and cost effectively for you to make sure that more of your money remains in your super balances. So on all of those important points that I just listed, Energy Super and LGIAsuper really do have more points of similarity than we do difference. Since announcing the opportunity last October, LGIAsuper and Energy Super have both undertaken a really thorough due diligence process to ensure that the potential merger is in the best interests of each of our members. There are a lot of quite prescriptive rules about what's required in order for trustees to undertake a merger, and the most important thing to remember is that that merger can only proceed if we find that it is in the best interests of all of you, our members. At the end of the current investigation process, which we expect to be actually within the next couple of weeks, we do hope to be in a position to let you know whether the two boards have decided that we want to proceed further or not, and indeed it does look very positive. Some of the key questions that we've been working through over the last couple of months in our due diligence process include how we would make sure that any Energy Super members who are transitioning across into LGIAsuper do retain the same types of rights that they had whilst they were within Energy Super. How we can combine our MySuper products into a single MySuper product, because that's all that we're allowed under our licence. And very importantly, how we would implement the merger, including leadership, board composition and transition planning. So all very important questions, and we've done a lot of work, I can assure you, on all of those. Should the due diligence confirm that proceeding with the merger is in the best interests of both sets of members, we think there'll be a program of maybe 6 months to finalise all of the work that we need to do to bring the two funds together by the middle of 2021. Importantly, we cannot do any of this without talking to you. We can't make any changes to your program without speaking to you. So you can expect to hear from us, certainly by the end of the year, with an update on whether we're planning to proceed or not, and then you will hear from us subsequently over the rest of the 6-month period. Again, I really want to stress that we will only proceed with this merger if it is in the best interests of LGIAsuper members. So that's just a little bit about the Energy Super merger, and of course we've heard from Troy and John today. And so now we're going to move on to some questions. I have a question here. And I'll give this one to you, John, first of all. So this is from William. Does the asset test include shares, or did the example only relate to the domestic home?
Thanks, William. Certainly, unfortunately, the asset test does most definitely include shares. So Pretty much it includes everything. The home is exempt. As I mentioned, underage pension age, there can be some exemptions on superannuation account. Other than that, there are really quite minor exemptions. For example, putting some money towards a funeral bond, those type of things allow a certain amount of exemptions. But what the government looks at in terms of assets is lifestyle assets, so disposal or trade-in value for things like cars and caravans and boats, basically everything, garage sale value for contents, and then real assets like shares. It's basically that value from at any point in time. Money in the bank, managed funds, shares, investment properties naturally, and certainly superannuation assets. So hopefully that answers your question, William. Okay.
Thanks very much, John. That's great. So I have a question from Brian for Troy. Interest rates are at all-time lows. What does that mean for members who have a more conservative investment approach?
Brian, that's an excellent question. John and I have been talking this evening about the trade-off between the certainty of low-returning assets like cash and bonds, and the price of that certainty, of course, is that you don't earn much money. For your short-term spending needs, cash may be an appropriate vehicle, but the challenge, of course, even for those who have a conservative risk appetite, is that we still need to take some form of investment risk to try and generate returns. So as I mentioned during my presentation, a key focus for us in the investment program here is to emphasise and build into the program more sustainable income generation by selling down some of those lower returning assets and reinvesting into other assets that generate a higher yield. We'll be doing more of that over time here.
Thanks very much, Troy. All right, I have another question for John here from Marion. Please confirm that a person over 65 years of age may contribute to super up to age 67, and just give us a flavour of some of the conditions.
Okay, thanks, Marion. So yes, so as I mentioned during this presentation, if you're 65 or 66 now, you can make contributions to your super. I guess one important aspect is your total super balance. So if you already have 1.6 million in your combined total of all super that you have, then unfortunately you can't make voluntary or personal contributions. That also means though, so there's a threshold applies of $100,000 a year. So unfortunately at the moment we're stuck with this slight problem while the government sorts their legislation out. So there's a slight different rule for people under 65 than applies to people who are 65 and 66. So if you're 65 and 66, it is limited to $100,000 a year that you put in for your own contributions. 64 and under, there can be 3 times, so it's up to $300,000 in 1 year. Importantly though, and something that might open up, you can also put in contributions for which you can claim a tax deduction. So the jargon for that's concessional contributions, but that level or limit is $25,000. And in actual fact, if you've been retired for a while, that might have built up, and there's a thing called carry forward. So it gets quite complicated, but if you're in a situation where you have assets or funds that you would consider adding to super, I guess what I encourage you to do is get in touch, because it also depends on contributions you've made in recent years, and it's never as easy as just saying yes, you can do it. So hopefully that goes some way towards clarifying that for you.
Thanks very much, John. A question from Bridgine that I'm actually going to answer. So does Energy Super use the same income protection insurer as LGIAsuper presently? So that's TUL, obviously. The answer to that is no. Actually, Energy Super uses OnePath, which is the insurer that LGIAsuper used 2 years ago. So it is quite interesting that we sort of move around the market. I guess what's important to understand is that we will take an orderly and a well thought through approach to making sure that we harmonise any of our offerings to our members and to Energy Super members. And we will do the work to make sure that members' best interests are kept in mind, and that you're not worse off, that you're better off. So, overall, we're doing a lot of work in a very planned and managed way to try and work out how we can provide an appropriate, simple set of products, and that's insurance and superannuation as well, post the proposed merger. We will continue to communicate with you. We will communicate with you before anything is done. And you can certainly rest assured that as we work through this process, our members' best interest is at the top of our minds. So a question for Troy now from Marion. Why are we invested in the gas pipeline and not in renewables?
Thanks, Marion. It's a good question. So the approach we take here at LGIAsuper is to act in members' best interests. And that means for us that the underlying investment strategy, as it translates into specific assets and managers, has to make sense in a business case. If we're able to buy assets at a sensible price and generate a good expected return from them, we are very much interested in a diversified program between, for example, the gas pipeline, renewables, and other sorts of investment strategies within infrastructure, and then of course between infrastructure, real estate, shares, bonds and cash. The extent to which the program here takes account of environmental, social and governance considerations, we think of that as a standard part of investment risk management. It's an important part of the program, we don't ignore it, but we're obviously interested in making sure that we're not too concentrated in any one part of the market, and that includes in terms of renewables versus non-renewable sectors of the economy.
Thanks very much, Troy. Another question for you, John. This one's from David. Is there relevant documentation that should be collated in retirement to help my legal representative proceed with a transfer or payout of my super when I eventually pass away? Not too soon, I hope, of course.
No, David, hopefully not too soon for you. Making me think there. So I guess importantly, first of all, and this is a question we've had from time to time, whatever is in your super, whether that's an accumulation account or a pension account, when you pass away, is certainly an asset that passes through. It doesn't go to the government or other places. And I guess in terms of the documentation, well, yes, there certainly is. To which one applies will depend to a certain extent on what type of account you've got and also what your beneficiary wishes are. So unfortunately, again, this is an area that can get quite complex with super. The legislation is very clear on who is a dependent under the legislation and therefore who a fund is legally able to make a payment to. I guess a common one where for a couple, it's usually fairly easy because it's often to go to the spouse. If that's the case, and if it's a pension account we're talking about, well, you can have a thing called a reversionary beneficiary nomination. That's quite simple because it's embedded in the application form. So when you commence a pension, you can say reversionary, and that means that for the life of that pension, obviously provided your spouse survives you, that you pass away, that pension will just continue on to your spouse. So that's probably the cleanest and neatest option. Then the next beneficial, and so that is only available in a pension account, not an accumulation account. Probably the next most beneficial or certain option is to use what we call a binding death nomination. They are able to be used in both a pension or an accumulation account. There is a separate document that you need to do, and a bit like a will, you'll need to sign it and also have two non-beneficiaries witness it, and we do need the original of that document to come back to the fund. They can be used regardless of whether it's going to a spouse, a child, or maybe through your will. So once again, hopefully that answers it. It's quite a complicated. We often get questions of, but what if I want to go to my wife, but what if we both die at the same time? And unfortunately, there's just only so far you can plan. So at any point in time, you can only make good decisions based on the most likely outcome, I suppose. And then like with everything in life, as circumstances change, that's important you're just aware and update things as necessary. And with the estate, a very good idea to seek some legal advice, make sure your wills are up to date, make sure your wills and your super talk. Sorry, I'll go on a little bit longer here, Kate, but it made me think of another important point, and that is that depending on the nomination you make with your super will also determine whether your will has any power over your super or not. So again, that example I used before, a binding nomination a reversion where it goes to the spouse, well, that money is never going to form part of the estate. So it doesn't matter what the will says about it, it's not going to cover it. And binding has that same ability to basically make the money go to a beneficiary and therefore not have the will deal with it. So that's where making sure that legal advice and what you've got in your will and what you've nominated to your super fund, it's so important that they're on the same, trying to achieve the same outcomes and they're not conflicted. So hopefully that helps.
Thanks very much, John. Another question for Troy from David. Can you explain a bit more about the new private capital investment option? I may have missed this detail in the faulty transmission. Just a note, David, it's an asset class. We don't have a standalone investment option on private capital. But Troy, if you could just talk to us a little bit about what private capital means.
Absolutely, David. So our private capital asset class brings together some of our higher risk, higher returning assets, whether they're value-add strategies in infrastructure or real estate, distressed and opportunistic credit. What we're really trying to do here is group together the assets with similar characteristics in the same that we do with infrastructure and real estate, or with cash and bonds, or with our share market investments. If you're invested in our diversified options, you'll get a portion of that private capital asset class in your underlying holdings. But as Kate mentioned, it's not available as a separate option for members to invest in directly.
Thanks very much, Troy and John. And thank you, members and guests, for all of your questions. We've done our best to get through as many of them as we could this afternoon, but we're out of time now. So if we didn't get to your question, please rest assured that we'll come back to you over the next couple of days with an answer, as long as we've got your contact details. So before concluding, I did want to remind you that LGIAsuper is not just for employees of local governments, but is open to everyone. So if you'd like your spouse or friends to enjoy the same set of benefits that you have enjoyed with LGIAsuper, then please talk to them about us and send them to lgiasuper.com.au. Also, it's great to be able to tell you that LGIAsuper has been recognised by a range of ratings agencies for the quality of our investment portfolio and also for our products. Also for our member education and for our customer service. We've been nominated multiple times for Fund of the Year. So we do hope that you've enjoyed today's presentation. We apologise again for the faulty transmission problems that we've had earlier, but I do mention that a recording of this presentation is going to be available on the website within the next week or so. Don't forget, I know there have been a lot of questions today for John, and it's really interesting to hear how technical it becomes at pension phase. So don't forget that at LGIAsuper we have a team of experts just like John who are here to help you find out as much as you want that is suitable for you individually about what is best for you to do. So please call us, call our contact centre to arrange a time to review your own personal circumstances. There are going to be some slides following this webinar with information that you may find useful on how we can help you with your superannuation needs. So in closing, once again, thank you very much everyone for joining us this afternoon, and I hope you have a terrific rest of the day.